Well, more evidence oil and gas are pretty poor bedfellows these days. Oil prices remain over $70 a barrel, more than doubling so far this year, while natural gas languishes below $3 per million BTU. Here to help us sort out what is going on and give us his take on an inventory report coming out for natural gas this morning is Elliot Yu, returning now from the Energy Strategist. Hey, Elliot.
Morning.
Always good to see you. Tell me now, oil, it did fall, and a lot of people see it falling below $70 soon. The latest is signs of rising supplies, more faltering demand, concerns over, is this economic recovery going to happen? So what do you say about the longer term picture? Is it bullish, or are the fundamentals still saying that it's going to be stagnant?
Well, the oil market has really rallied in anticipation of improving fundamentals as a result of the economy getting better. And we're starting to see the economy. I think we're probably out of the recession, and we're probably going to see a recovery going into the latter half of the year and into 2010.
So this drop from 75 earlier this week till now is...
I think a lot of that's technical, because if you look at the chart of oil, earlier this summer you saw oil really bump up against that $74, $75 area and then back down to as low as 58, I believe was the low, and it sort of rallied back up again, and it's hit that area, kind of a technical resistance area. My guess is there are a lot of traders out there who are looking to sell into that area. What'll be the real test is if we break above that level, just from a technical basis, you could see oil run up very quickly over 80.
So the inventory levels being over the 5-year average for so long, it doesn't bother you?
Well, certainly. I mean, that's been, but everybody's very, very aware of that fact. And in fact, if you look at the inventories, they have been dropping pretty sharply. Not this week's report was kind of neutral, but last week's report we actually saw a pretty big drawdown in crude oil inventories. So they are starting to normalize, and the question really is, when are we going to see demand really pick up? I mean, we've seen demand stabilize. In the most recent report, year-over-year oil demand is only down by less than 1%, according to the EIA's report. But we really need to see that sort of industrial demand for oil really come back. I mean, motor gasoline demand really has been okay. So it's really that industrial demand for oil as well.
Much the same story for natural gas, yeah. So the inventory report coming out for that this morning, oil prices or gas prices hovering around 280 now. What are you expecting?
Well, we're looking for about a 50 to 55 billion cubic foot build in natural gas inventories, which isn't unusual for this time of year. We are in the, we're still in injection season in the sense that we haven't gotten to the winter heating season yet, obviously. This is kind of a funny time of year because a lot of people are looking at the tropics for the potential for, a hurricane to maybe disrupt supply as it did last year. However, the natural gas market, the story there has really been much the same. Storage levels are approaching their physical maximums, and that's been the case for some time. I think the counterbalancing factors would be, as we move into 2010, will demand really start to come back? The key, again, is industrial demand. We saw the industrial production figures tick up for the first time since 2007 in the most recent report.
Sign.
That's a positive sign for demand if that continues into 2010. And then the other key thing, I think the real wild card out there is supply. I think that's what people are kind of underestimating, the potential for supply to really fall off. And if you look at some of the decline rates on these shale fields, Haynesville, for example, Chesapeake's saying their first year decline rate in that field is something like 80%. Meaning that if you stop drilling, it doesn't take very long for your production to drop off.
And the rig count has dropped by about half, and fewer new wells are being dug?
Absolutely. I mean, you've seen a little bit of an uptick in the rig count lately, but if you look at the actual numbers, most of that's oil. And you can see why. I mean, a lot of companies that can go out right now, if you look at the oil futures market curve, in other words, the different oil prices over, say, the next couple of years, you can go out and hedge 2 years in the future for $85, $90 a barrel for oil. So drilling oil is quite economic.
The story that we talk about a lot, but now it seems to be reaching mainstream media, is this divergence between oil prices and gas prices.
Right.
The talk has turned to why gas prices are so low as oil has surged. Oil is now 4 times as expensive as gas to produce the same amount of energy. So what is that telling you? What does it tell you that this is now in the national news?
Well, for one thing, I mean, that's a ratio that has always sort of seemed to have been sort of mean reverting. In other words, oil and gas tend to trade at sort of a level against one another. But if you look at the actual demand for oil and the actual demand for natural gas, there are a lot of differences there. In other words, oil is primarily a transportation fuel. Natural gas, as of now, is not really a transportation fuel. It's used for electricity production. It's used in for industrial purposes. The other thing about the difference between the oil and the natural gas market is that U.S. natural gas prices can vary very widely from natural gas prices in other parts of the world.
Okay, so oil is a global commodity.
Exactly.
Natural gas is not.
Exactly. So that relationship is tenuous at best, as far as I'm concerned. That's not. I mean, if you want to buy natural gas here, if you think that natural gas is going to rally, I think your main reasons would be expecting an uptick in demand and further declines in supply, rather than it normalizing with oil.
Is it true that gas is now cheaper than coal, and is that going to bring some attention to gas and away from coal?
In fact, it has. This summer, we've seen a lot of that. We've seen a lot of utilities doing fuel switching that are allowed to, or they're able to, where they're favoring natural gas over coal. I mean, if you look at natural gas demand, and the EIA does break it down by, what sector it's being that demand is coming from. Electricity demand for natural gas has actually been pretty resilient, especially when you consider that electricity demand is down year over year, primarily because of the cool summer. So even though we've had a cool summer, electricity demand has been down across the board. Natural gas has actually gained market share in the electric grid as a result of extremely low prices and high availability.
Tell me about this U.S. Natural Gas Fund, UNG, and its role in prices. Now, I've been reading about a way that it buys futures, and selling the front month contract and buying the next contract is actually affecting the price.
Well, there's been quite a bit of talk about that. If you look at UNG's website, they tell you exactly how they go about rolling from one month to the other. Everybody who wants to buy natural gas futures has to figure out how they're going to roll from one contract to another. Some funds or some ETFs roll continuously, meaning that they gradually roll over time. Others, like UNG, do it over a shorter time frame. So the tendency would be that if it's rolling, UNG, the front month futures would be sold, and the next month out would be bought. So you would tend to see somewhat of a widening in the spread. However, you do have to remember that this isn't a secret. I mean, everybody knows how large UNG is. Everybody can look on their website and figure out when they're going to roll. So traders are going to start to anticipate that several weeks ahead of time. If they know that sale or that selling is coming into the market, they're going to tend to anticipate that several weeks ahead of time.
Okay. So what is all of this telling you, Elliot, about what is next for natural gas? Or is it just basically more of this odd volatility?
You're going to see a lot of volatility over the next couple of months, because we're nearing the period where we're going to hit sort of our peak storage levels. The big question is, what happens after November, when we hit that peak storage level, and we start to move into the winter heating season. And if you look at the futures market curve, natural gas prices are forecast to be more than double where they are today, next summer, if you look at where futures are trading. And I think that the market has started to look beyond the next couple of months towards, again, and it's very much the same story as with oil. Recovery in the U.S. economy, a recovery in a lot of developed world economies, a re-acceleration in growth in the developing world. And again, that real wild card is to watch those EIA statistics on how production trends over the next several months. Right. The EIA 914 report is the key. It's released with a 2-month lag. We started to see in May a very large decline month over month in U.S. natural gas production. If that continues in the next report, which is released at the end of this month, that'll be a good sign. That will help bring the natural gas market back into balance.
Okay.
And then there are a lot of other wild cards out there as well. I mean, is it going to be a cold winter? Are we going to have a hurricane? But I mean, the main thing is to look at. I think that supply is going to be key.
Right, and a comeback in industrial demand.
The comeback in demand coupled with declining supply, you have a potential for a real spike in gas prices if those two match up. I mean, we had the perfect storm on the downside where U.S. natural gas production surged just as demand fell off a cliff. If demand starts to come back just as production really falls off a cliff,
good spike.
You have the opposite sort of perfect storm.
All right, well, we will be watching. Elliot Gue, thank you.
Thank you very much.
We appreciate your insight.